Hello and welcome everyone to the weekly Delphian meeting. Our agenda for today is we got Ashok. He's joining right now. We have Ashok going to come on and talk about some things here. Welcome, welcome Ashok. So we'll let him go first, and then.
Hey Josh, hello everyone.
Yeah, we got some background noise.
Oh, is it? That's my computer, I think.
Okay. Yeah, just tell everyone, we'll not take up too much of your time, but let you go, and then me and Sean and Joe can hold on after and go into anything else.
Sure. Hello everyone, joining after a long time. How are you guys?
Thank you.
Good to see you again, Ashok.
Oh, hi Jean. How are you? Okay, let me share my screen.
Yeah, the background noise is pretty bad. So.
Oh, pretty bad? Just give me a second. Just give me a second. I join by phone, then we'll.
Okay.
Connected. Josh, is it better now?
Oh yeah, crystal clear.
Okay, that's great. Sorry about that. Okay, let me share my screen now. Okay, so Joe and Josh gave me a little more update on what you want to hear from me. And first we'll go and open the market and then see what the market did in the last few months. Nothing new here, but we'll start from there. So if you pull the overall market, if you see the market has gone from a V recovery since COVID started, and then dropped almost about 35-40% back here, and or even more than that. Like I think it is around 40%, and then grew about 87% from the lowest point in the during the COVID times. And right now where it stands is all new blue sky territories. Nobody knows where it will end and when it will end. So that's a big mystery right now, right? So at the same time, when we are seeing this, most of this price is driven by the very good momentum what we have in the market, and also a lot to do with the COVID forbearance models, where the people were forgiven on the mortgage payments, and people were given money to spend, or rightly, wrongly, whatever is the scenario, it will be different from one person to another person. But no matter what, everybody got it, and some people have extra cash, some people have cash to survive. So for all good and bad reasons, it's a health crisis, and the government response to the health crisis is what resulted this momentum in the market as well, assuming that the businesses also will come back and recover, right? So if you look at the broad business, right, at an S&P 500, I think I'm going to table that for Joe and Josh and Sean to come back to you next week with a complete analysis. Whether S&P 500 companies, the 500 companies within the SPX index, did they make money during this period? And did they make enough money to distribute the dividends to the stockholders? Like assume you all are stock buyers and you hold stock and you expect dividends from the profits. So are the profits increasing in line with the markets? And the obvious answer is no. But there is a little more deeper analysis that Josh, Joe, and Sean can do on that. So the question is like, how do we make money as option traders or as stock traders, right? And Delphian, in Delphian we have created a model which measures the fundamental strength, right? When the market is going good and at a good pace in the right direction, the fundamentals doesn't matter, momentum matters. When the momentum is losing, that's when the thought will come back to the fundamentals. So, and sometimes or many times, the fundamentals are the same fundamentals are viewed with a negative lens in the media once the downfall starts. But when the momentum is good, the same fundamentals are talked about in a positive angle, right? That's the problem. That's the noise level what we have in the media and any kind of news outlets, right? Because they don't want to be the outlier and write something about like when the market is going the other direction, and it's a more of a perception management is what these guys were doing, rather than writing the own analysis. Not that they know the truth. They do know the truth. They do know the money flow. One measure like what we strongly follow within the Delphian research team, as well as any of us, if you talk to Josh or Sean or Joe or myself, right? We strongly advocate like looking at IWM as a market indicator, right? So question yourself, like what's this IWM doing? Yeah, I mean, there is a momentum that went up in 2020 after the stimulus packages and after the second stimulus package again. But the momentum is being lost since beginning of this year, right? So when we see a difference of momentum in IWM and SPX or a Dow Jones, IBM is a master. IWM is a master because it is a composite of 2,000 small business stocks. So you're not talking about one or two big guys, elephant in the room bullying like rest of the people. That's what it does. Like in the Dow Jones, it's only 30 stocks. You only need one or two stocks doing extremely well to shadow the remaining 28, 29 non-performing stocks. Similarly, the S&P 500, you need only about 10 or 15 stocks doing extremely well to shadow the remaining 400 stocks. I mean, so that's the momentum that they have. But when it comes to the IWM, the weightage and the distribution is so not so narrow across a small portfolio of stocks. I mean, there is a greater distribution of diversification in this calculation. So that's one of the main reasons why we advocate like looking at IWM when it goes there, right? Also, in addition to that, like let's take a look at what the Fed is doing actually. So if you look at the broad Fed, what it can do, I mean, this is not only useful for this one, but in general to understand the Fed, right? And we'll come back like where that money is going, why the momentum is being lost, and where that money is being circulated within the investment community, right? So we'll come there. So if you look at this is a standard disclosure, like what you see here is for learning purposes, not an active investment recommendation. Okay. So one of the biggest tool what they have is the changing interest rates, right? So we know that the Fed can change interest rate upward as well as downward, and they have certain framework using which they determine like, okay, it's time to increase or it's time to decrease. But this is definitely one biggest power like what they have, and because all the mortgages or the lending community follows these rates, and everything is based out of what Fed determines the interest rate is. So when they see an economy is going extremely good, and they want to slow it down, so that's the time where they increase the interest rates, and by increasing the interest rates, I mean, they also reduce the, a spending bug also will be reduced. I mean, you don't buy a new car unless you really need it when the interest rate is high, versus when the interest rate is 0% or 1% or 1.5%, you might be buying car 2 years early to when you actually need it, right? So that spurs the economic activity. So one of the bad things that happens when interest rates are reduced is the economic activity will be kicked in, and the effects it will take about anywhere between 12 to 18 months. It does take the 12 to 18 months period to see the after effect of the interest rate reduction of the Fed action. So one way they measure is like what is the inflation like? So that's a byproduct of the humongous amount of money being spent in the economy. And like for example, if this 20 people want to buy a car, and I say like who is willing to buy 100 for 100? I mean, in an auction environment, right? Let's presume. So there may be another person who will be willing to pay 500,000, 10,000, 20,000. Maybe the car value is only about 19,000, but there is some person who likes it and wants it, and the interest rate is low, and the total cost is not going to the principal plus the interest claim cost is much less than what it used to be. Then they are willing to pay $21,000 for a $19,000 value. There is $2,000 more, right? That's exactly what happens when more money is available for spending or borrowing. But that encourages the economic activity, which is what is needed after the COVID. Then people stop shopping and going out, and the business are confused on how to reach the consumer and how to sell, and the employees are confused how to deliver the work. So there's a lot going on, but that economic activity should not be slowed down. That's the government's responsibility, and they responded with a lowering in interest rate, never done in about almost like in 1 or 2 weeks. They reduced 1.5% as a sudden response, right? So that's one thing. And when interest rates are too much increased, then it will be more tightened, and the deflation is also a problem. So there is a normal level of response is okay. Like what used to cost around $100, next year, if the same product is quoted around $102, psychologically we are all fine. I mean, okay, I last year I paid 100. I'm okay to pay 102 now, right? The time value of money, today's money is more worth than tomorrow's money. Like the same $100 will be worth only about $90 after 4 years, right? Because that's a buying power what you have, right? That's what there is a normal acceptable level of inflation, and that's measured in terms of the consumer price index. And if you look at consumer pricing index, it's just another classic way of calling what is the buying power, right? And if you look at the components of the buying power, housing constitutes about 42%. I mean, housing in the sense, if you want to buy a new house, if you want to buy an existing inventory home, or you want to rent a home, and what's the rent in the marketplace, right? I mean, that constitutes around 42%. So it's a very biggest component of the buying power. And the second is like the transportation, and the third is the food and beverages. These are basic necessities. People want to move around and eat food, and so the basic necessities buying power is what is being measured, which is almost like around 72% of it, right? Rest everything else comes like as a discretionary. Of course, we all need apparel, but we don't need too much, right? And we can slow down, and we all have closet full of clothes. I mean, most of the American population do. So that's not like an immediate necessity. It's not going to make a huge difference in the buying power. Like, so they are measuring the basic necessities of it. And if you look at what happened to housing, and this is, I just took a printout of Zillow value. Like, it is not accurate, but it is pretty precise. But trending wise, it shows the trend, right? In about last 8 years or so, if you look at it, it's almost doubled. The price of a home doubled. But more concern is like not the doubling of the price of the home in 8 years. The more concern is 25 to 30% of the growth came in the last 6 months in this year. So that's what we are seeing right now. When the Bureau of Statistics reported the inflation, we are almost around 4 to 5% consistently for 2 months. So if this continues, what that means is the Fed is going to, or let me ask, like, what would be the Fed action if they see the continued rate of interest, continued inflation going in that direction? What will they do? You can use chat to answer. Will they increase the interest rates? Any respondents? Yeah, interest rates will rise actually. Yeah, interest rates will rise. Yeah, the interest rates will rise because inflation at a 5% is not acceptable. Inflation at a 2% is acceptable. Anything more than 2%, and if it consistently happens for a couple of months, that's where they go and raise the interest rates and slow down the economy. So it's the time is coming, like where the slowdown is going to happen. The interest rates will rise. That's one. The second is like a lot of the forbearance, the rent forbearance, or the forgiveness on the loans and all of that is coming to an end, or it almost ended. Like, I am not tracking that one, but very close to that end point where all the forgiveness is going away in the market. And good news is like employment activity picked up, and people are 60% is vaccinated, and people are able to go out and spend some time outside, even though a little bit hesitant, but that needs to increase a lot more, like by end of this year or maybe next year, Q1, it will happen as well. So that economic activity, so by increasing the rates slowly now, gradually, they're going to slow down that economic activity at the time, like where the fear is going away from the normal economic activity. So another tool what they have is the second tool is the open market operations. So they have this something called treasury bonds, and the treasury bonds also, they are like government is taking money from you and giving you a interest and a piece of paper saying that I owe you, and I will give you $102 next year if you give me $100 now. That's a pretty, when government is doing that, our confidence in government going bankrupt, is very low. There's no chance, right? That's like almost like a picture perfect risk-free interest saving account, right? They don't go bankrupt. So that's one way of giving the cash to public. They are giving away the note, a piece of paper, or they are selling they are buying the note back, they're buying the paper back and giving cash to you, right? So that means they are increasing the money supply within the market, the money available. Today it's $100. Let's say like all together, all of us, 20 of us have about $10,000. And Josh comes and says like, hey, I will give you $1,000 more, and you give me back some of your securities, or which is worth like maybe like $100 or so, right? So you give him back. That means our total pool of money increased by 21,000, by another $1,000. So now we have $21,000 to spend, like, right, 1,000 more, right? That's how the general public gets cash from the government, just the normal economy. Another way, like when they want to reduce it, they take away the cash from you and they give you the piece of paper, like that's when you buy the bond from them. And then they give you a set interest rate, a small interest rate, to encourage that for you to give away your cash. So in a way, this is another tool to control the interest rates as well. What happens is when they are doing this treasury bond activity, that has a direct effect on interest rates. So that's what they want to achieve. So when interest rates reducing and increasing doesn't work, they will start this open market operations by using the T-bonds. So and also when you look at this banks, right? The third thing they have is the reserve requirements. I mean, if to understand this reserve requirements, you need to understand how banks operate. And many of us have seen you open a checking deposit account with a minimum of $100, we'll give you back about $300, right? And if when bank advertises that, and I go deposit 100 and I take 300, I mean, as a cash back return after 90 days, is that good for bank, or is the bank losing money on that? Can you type in the chat? Is it good for bank? Yeah, so the bank benefits from that. It doesn't lose. The reason is, if they have $100, I mean, if they have $1,000 in deposit, I mean, let's keep to that $100 deposit. They can pay the $10 of that deposit as a reserve, and and they can lend the remaining $90. So for every $10, they can lend $90. That means if we deposited $100, now they can loan $900 worth of loans. So that's how they benefit. So your 300 will be coming back, to them in the form of the added leverage of how much they can lend to the public. So that's how they make money. So when they deposit this money, and that becomes a liability because they are supposed to give it back to the depositor, right? Whoever deposited, they need to return back the money someday, or they need to safeguard that money. Any depositor can go to bank during the banking hours and say, I need my money back, and they need to give back that money, right? They have an obligation to give back that money. So their only hope is okay, if they have about 10,000 depositors, their hope is not all 10,000 depositors come on one single day and single hour and ask for cash. I mean, it's only probably around 100 people or 200 people or 300 people on a daily basis. So they're using statistics to calculate the liquidity perspectives. And the Fed and the government thinks that 10% is good enough to manage that solvency risk, right? When banks, when people run to the bank, that's called run the bank. That means they have lost confidence in the bank. The bank is going to get closed. I want my money back before it closes the doors, right? So that's a panic scenario. What happens, right? So when they give loans and to the customers, and those loans also will become assets to them. And there's liabilities. I mean, the deposit is a liability, of course. And the investors who started the bank invested some money to get kick-started, right? Maybe they started with 10 people, banking with 10 people, or maybe 100 people or 200 people and things like that, right? So they invest some real money. That's called equity. And the way the equity is given is they go and deposit it in the central bank, and the central bank gives an interest rate to them. But at the same time, that will allow them to secure a lot more money, lot more actual paper from the federal government at a discounted rate, and that discount rate they take it for let's say they take it for 1%, they give loans for 4%, 5%. So that's how they make money. What the difference between that, what their cost is, and what their income is, that's called the net interest margin in the banking world. And every bank discloses that. If you read the annual report, of any bank, just control find in the annual report, net interest margin, you will be able to see it. Usually it's about 3%, 3 to 4% usually. And right now, as we speak, right now, it dropped around 2.5 because of the COVID and because of all the less activity that's happening on the economy and all. Last year it dropped to 2.54%, but usually it's above 3%. Like that's what they make money on. On top of that, they have hundreds of banks and hundreds of a lot of technology to run and a lot of operations to run, customer service, phone calls, like so on and so forth, right? So if they're making only that 3%, how do they fund all that operations and the branches and the real estate leases, rentals, and all the stuff, right? So what they do is they charge fees for every loan you take, and they charge fees. And even if you want to go and have a check printed, they will charge you $10, $20, and $30, sometimes up to $40, depending on how good the check should be looking, right? So all of that is a profit. Like usually it costs about pennies for them to print the checks, like so, and they charge in dollars. So that's where they make money a lot on fees, and the fees is what makes the bank let them operate their operations, and at the same time grow the bank as well. So the fees helps that way, and portion of the interest will be reinvested into the bank's profit, or the portion of it may be going back to the actual investors who started, right? So what will banks do is banks have a nice facility when they fell low on that reserve requirement about 10%. What they can do is they can go to another bank and take loan from another bank. Like let's say I need to show 10 million to central bank, and I have only 9 million. I can borrow 1 million from another bank who has excess capacity, excess reserve in that one, and they of course ask interest payment, and so it's more of an unsecured loan, and also it's at a much cheaper rate than what the central bank can gives the money, assuming that you have a full deposit. But they give 9 times of the deposit, but the central bank charges the interest rate. Usually it is much higher, but that is done to encourage the touch me not behavior. Central bank doesn't want to be in the middle of it. They want a self-sustaining banking system to be run outside of them. And when things don't happen properly, that's when they come in again. They come in again and rescue. And to rescue that, they created about, if you look at 2008 and 2009, that financial crisis, predominantly it was triggered because of the financial industry themselves, and because overextending the loans, and the economy, the economic activity increased a lot, and it went into a boom bust into real estate. But the underlying issue is not the real estate by itself, but it is a self-inflicted push of willingness to give no documented loans, and also encouraging every American should own a home, and so there's a broad political campaign that's done in 2000, and so to demonstrate that, they let it happen, and they reduce the Fannie Mae requirements, or all those FHA loan requirements. They dropped that to enable for people to fulfill the dream, and which is good. But the bad news is it went beyond the sustainable level, and it has brought a lot of banks to have the bad loans. And if you look at it, loans are part of the assets, right? So when banks were about to go in insolvent stage, and they are about to declare bankruptcies, and there is a fear that run the bank will happen, and a lot of people will go and ask for money back from the banks, and the whole banking system will fail, right? So to prevent that, what the Fed did is they said, hey, I will take off your bad loans, and I will exchange that with the treasuries. So basically, I will take all your bad books, and I'll give you a paper that you are clean, right? So they saved the banks by taking off all the loans in exchange of treasuries. treasuries note. So basically the asset mix of treasuries and loans, that's changed on the bank. That way the banks look strong. And another thing what they did is whenever they do this, any kind of treasuries or treasury buys or the reserve deposits or if any bank goes to the central bank, they need to disclose to the public, and every day an Excel sheet is put on the Fed site. Anybody can go and download that and see like if your local bank had borrowed money from central bank. That should be a full transparent model. And for a period of time in 2008, 2007 and 2008, when they announced this term action plan and the term securities plan, so they said, okay, banks don't need to disclose and we don't tell which bank borrowed how much money. So it's totally kept in dark. And the only way you know that the loans are being swapped is because when JP Morgan or HSBC or Citibank or any of those banks come to the annual reports, publish that, hey, like we are reporting a $5 billion loss now in the back quarter. But hey, guess what? Like we cleaned up around $2 billion loss from that $5 billion. That means our current loss is only $3 billion. So and another quarter later, hey, like we are profitable again, right? Because that $3 billion is wiped out, right? So it's just a matter of switching the assets from one to another, and whenever this happens, the entire responsibility of treasuries goes back to the entire citizens. So indirectly, it is every one of us. If the federal government debt is increasing, then we have to. It is basically how many dollars per each person in United States. So we all own that debt. That's a liability on each one of us. If something happens and government asks everybody to cover the debt, and if it comes to around $10,000 or $20,000, each of us have to give back $20,000 to cover that debt. Like that's what it means. And of course, like they might not ask, but they can ask, and it happened in certain countries, and it might happen in US as well, going by the federal actions sometimes. Okay, so now another way, like when that term, in addition to this term and securities lending, what they also did back then was like, which was not a big tool up until 2000s, but in starting 2000, buying long-term bonds for more money supply. That means like they are printing money, they're printing more green, and leaving that money on the market, and in turn they're taking that paper in hand, right? So this is what is not good. This is called quantitative easing, and some of you know that, right? So it's basically, the concept is very simple. When it comes to the spread, and they pay. Today if you go to savings account, they pay about a penny or maybe 10, maybe a nickel, or a max a dime, right? If you invest them in savings or CDs or any of those. But they charge about 4 to 5% on the interest rates, or if it's a primary home mortgages, 2 to 3%, anywhere between around 3%. And if it's investment or a business loans, like it's going around 4 to 5% right now. So that's where the bank gives the difference, like which is the spread, right? So the other part, what they do is like influencing market perceptions. So which is via the minutes of the meeting. There are 8 FOMC meetings in a year, and there are 12 Fed windows where banks can go and collect money from the federal government, and so they are distributed all across US, and like a Fed Louis, St. Louis, or New York, like that. There are 12 windows. So each one has a chairman and a chairperson and a big governing body and a team. So a pretty good number of economists. So they all get together 8 times and decide like, okay, what should they do in the future and in the upcoming quarter, and that's what they come and announce very not so directly, but very diplomatically. They say economy is strong and growing very quickly. That means interest rates will rise. So that's the interpretation. That's the clue that they are giving to the market, and the bond prices, bond interest rates will always increase first. And I mean, the bonds react first, immediately. The moment they say that, like all that pricing is already embedded within the pricing model. And when the market really sees the announcement of the interest rate increase, when they expected about a quarter point increase, and if the Feds increase half a point, then they react again. And when the expectation was half a point, and the announcement comes as a quarter point, they react again, right? So that's what they want, like the influence the market perceptions. They never want to give a direct answer under this tool. So whenever you see a FOMC, sometimes it's like a mixed message of this one, contradicting with the previous action, what they are doing, whether raising interest or decreasing interest. So having said that, let me switch the presentation to another one. If you go to the current market, what's happening? Yeah, we will jump into this one. Like just before that, like Josh, is there a way to open up for questions?
Yeah, Ashok, they can chat them, or we can just give them, just unmute yourself and you can ask questions. I think we have one hand raised. Dave Russ.
Yeah, I was kind of waiting until you got through with those 2 points, and thanks, Ashok. That really helps understand what the Fed can do. I guess my question here, because I think where you're going with this is the Fed's liable to make some changes in the near future or even far near future that are going to really impact what the market's been doing. So if the Fed, my question kind of comes down to the 2 things that the Fed can do. They can raise interest rates or not, or they can stop buying as many bonds as they've been buying. And my opinion or my guess is they'll stop doing that before they raise the interest rates that might be farther out into the future. So both of those major kind of things that the Fed can do affect the bond market, and the bond market affects the equities market. So
that's correct.
If I'm more worried about what the bond, what the I'd say deep pocket institutions and hedge funds are going to do when the Fed starts to tighten their policy, so maybe way before they actually raise interest rates, because I think the bond market will react significantly in one direction. And I'd be interested in how you think that might be. But I think however the bond market reacts is going to influence the equity market way before the interest rates come around to changing. So,
yeah, got it.
Can you address some of that?
Today's bond market is almost dead, right? I mean, unless you already invested in the previous bond with a higher interest rate, you don't want to go to the bank and open a bond today, like with today's interest rate, and commit yourself to a longer term, right? Because it's very low interest. So that kind of spurred, instead of going and buying a bond, I would rather go and buy a McDonald's stock, which is more fairly stable stock and stable company and a known company and less risk, right? I mean, I'm okay even if I lose money, but I'm willing to take that risk. But I will get a better return at buying McDonald's versus putting them in the bond and not growing anything at all, right? So they reached a point, like, I mean, when interest rates rise and bond markets come back, then bonds are relatively safer than stocks. So the money will get shifted from stocks to bonds and back again, right? That's one way of getting impact. Other than that, like, there are also other factors that impacted as well. Like today, if you look at this is an extension of that concept itself. So it shows like the gross GDP, right? The GDP, if you look at it from the 1950s onwards to 2020, most of the time it's in a stable rise, sometimes exponential. There are some dark periods, like very short dark periods. But 2008 took a little longer, and by far after the 1929 or whatever, this is a great recession, definitely one of the biggest recessions in that period, right? So where we have seen the GDP shrunk and then again increased massively, almost around 25-40% raise in GDP, right? So what happened in the Corona time, this last year for a brief period, the GDP has gone completely down. And not only that, the GDP has gone down, it shut down a lot of manufacturing, which shut down the supply of a lot of raw materials, and be it a lumber, or steel, or the basic necessities of normal economic activity, which jumped up the house's price, because if you still want to construct a home, you need to pay more. That's the primary reason why the housing prices started increasing based on the today's market. It's not sustainable. That we know that, right? And if you look at another view of the same chart, how the GDP up and down happened, right? This is like a percent change. If I measure the percent change, it's been within the range of less than plus or minus 10% by far, right? Most of it, like 95% of the points you can catch within the 10% range, right? And the growth was almost since 1980s, it almost pretty much very constant, except there are one or two downfalls, right? 1993, and then this is the 2008 recession. So, but if you look at the last few months, or last 18 months, this is the level of activity that happened. The GDP was shrunk around 30%, and GDP increased by another 30% from a point, and then starting to coming back down again, right? So my point of showing this one is, even economists don't know how to react to this kind of abrupt up and downs, and they're waiting to see what is the right action to do, right? So, and if you look at the federal funds rate and the discount rate, and I told you the federal funds rate is the interbank loan rate, and the discount rate is the central bank loan rate. So central bank loan rate is usually higher than the federal funds rate anytime. But right now they are all equal. Everybody is at a near zero, 0.25. They can't go any lower than that. And if they go lower than that, it's a negative interest rates, which is what the Japanese government did a long time back. They're not able to come out of it. That's more dangerous for all of us, because the value of money will keep going down over time, right? And if you look at this risk-free rate of return, this is the 10-year T-bond rate, and it used to be more than 3% back in 2018, 2019. Not long time before the coronavirus started, and it started reducing a little bit before the corona, but it took a deep nosedive, and this is where the bond market was not doing so good, and the stock market was doing, and people are flocking towards the stock market. So this is the normal growth of activity. So again, started to raise that one. T-bonds are at least paying more than 1% about in this year. But they were below 1% almost all of last year, right? So only this year they went beyond 1% here. So this is another important measure. So if I take my money and put in a T-bond, and if I get 3%, and if I go invest in stock market, if I get more than 3%, and I'm taking more risk, so my normal expectation is I should at least get 6 to 9%. Otherwise, it's not worth time and sleeplessness or tension. Sometimes that worrisome, right? That it's not worth. If I don't get 3 times or 2 times the risk-free rate of return, right? So that's what the measure was. So when the rates are so low on the risk-free rate of return, people will say I'm okay getting 2%, 3%, 4%, 5% return on the stock market. I don't need 10%, right, in this market, because nowhere else I can get a guaranteed risk rate of return more than that 1%, right, or below 1% range. So this helped a lot, and these rates are there. these rates are very important for the banking industry also, and they determine the rates for different types of loans that we need. If you want to leverage, right? If you want to buy a real estate, like you need a loan, and they're based out of these LIBOR rate or a 10-year T-bond rate. If it's a fixed rate of return, like it's a 10-year T-bond. If it's a variable rate, like LIBOR, and if you're having an active business and a small business or a big business, then usually they get business loans are short term, and they are only about 2-year rates, rate adjustments based on the LIBOR rate. Every year they change. That year rate will be changed based on LIBOR rate plus in addition to that. Usually it is always a plus based on the business risk, in which business you are in, and what is the manager of that business, what is that person's credibility and credit history, and the payment model, like what they have, and the structure of the loan itself. Like there are a lot of other factors going, like how this loan rate will be structured. But the underlying principle is, if LIBOR rate increases, the cost of doing business also will increase. And so with all of these prime rate, LIBOR rate, 10-year bonds being low, and the businesses are the cost of doing business became cheaper for them. And which is what, like the assumption in the stock market, okay, the cost of making money is lower, so the businesses will get profit. So that's the statement I will leave at that. Whether that really happened, the profits really came back, or are the companies trying to do get more profit, right? That's what we need to think through in the next session. For example, what Apple does in an environment like this, I don't know how many of you are tracking Apple. They're issuing bonds, corporate bonds. They are issuing, like they are saying, like, okay, if an savings account is giving about 0.10, they're issuing corporate bonds and telling the people, hey, we'll give you a 10-year bond for 0.75% or 1%. So that a lot of people say, like, yeah, that's good. And Apple is not going to go bankrupt, and that's good. But when you look at the balance sheet or annual report of Apple, they don't have any loan. They don't need a loan. They have excess cash. They have about $300 billion excess cash. Why are they taking that money? And that's for future. So they take that money because the money is cheap. The cost to borrow is cheap. So they are putting that, doing that, and then adding to their cash pile, and with the intent of purchasing someone else when an opportunity comes across, and either to do an acquisition to enhance the capabilities, or increase the manufacturing production facilities to increase the profit margin. Like that's what we need to see. So there are still some companies who are very sensible in utilizing this environment to their advantage, and those are the companies we need to find and start buying those stocks. So that's one way of doing it. The second way of doing it is, if you look at the grading model, what we created in Delphian, if you go and look at the A-grade stocks, on average, they increased about 20-25% in this year, versus the B-grade stocks about only 10%, and C-grade stocks probably are losing money, like and overall in this year, right? I don't have the exact statistics. I mean, that's the exercise which we will table for the next week discussion. And also, like in the money spreads and calendar spreads will do good in this scenario, and how those play out we'll cover next week. Is that fair enough?